Okay, so something very frequently tested on the AP exam are these determinants of exchange rates. And we call them determinants of exchange rates because these are the reasons that we trade with other countries. And when we import and export with other countries, it creates a demand for currencies. And that's why they're called determinants of exchange rates, but you can really think of them as determinants of trade. Why do we trade with other countries? Why do we buy goods from other countries or they buy goods from us? And it's goods, services, or financial assets. And when we're talking about financial assets, we're talking about things like bonds, stocks. Okay, so the easiest one is change in tastes. So that's just saying if we like products in France, we're going to buy goods from France. When we buy goods from France, we have to pay. We're going to import goods from France. We have to pay in the currency of the country. So it's going to create a demand for the euro. So that one is pretty straightforward. Let's go back up to changes in relative prices. So students sometimes are not quite sure how we measure relative prices, but what we're talking about are inflation rates. So please keep in mind that inflation is the general level of prices in an economy. So when we're talking about changes in relative prices, what we're talking about is if the inflation rate is relatively lower in Germany than in the United States, what are Americans going to do? We're going to buy the relatively cheaper products in Germany, and again, when we import those goods in Germany, it's going to create a demand for their currency. The next determinant of exchange rates is changes in relative incomes. So that has to do with jobs, and if people have jobs in a country, they have more money in their pockets. And when people have more money in their pockets and they have higher incomes, not only can they afford more goods in their own country, they can afford goods in other countries as well. So let's say the United States is in a recession and the euro area is growing well. Their GDP growth is strong. What that means is we're not going to be able to afford imports from the euro area because we're in a recession and we don't have as much money. Americans don't have as much money in their pockets. But on the other hand, if Europe's economy is growing strongly, citizens of the country will have money in their pockets and they'll be able to afford imports from the United States. So that's an important determinant of exchange rates and trade. And again, remember, if they can afford imports from the United States, they'll have to pay for those imports in US dollars. It'll create a demand for the dollar and the value of the dollar will appreciate. And the last one is changes in relative interest rates. And I like to say that financial capital follows interest rates. The countries that have the highest interest rates are going to see an inflow of financial capital. So if the United States, as we actually do now, we're starting to have higher interest rates because the Federal Reserve is raising interest rates. And if our interest rates are higher than in Europe, because the ECB right now is keeping interest rates still low, then citizens in Europe are going to say, hey, you know, I've got money that I've saved. Interest rates are higher in the United States. They're going to buy bonds in the United States because our bonds are paying a higher interest rate. Again, they have to pay for those bonds in US dollars. It'll create a demand for the dollar and it will contribute to an appreciation of the dollar. Ceteris paribus, all other things being equal.